Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. The growth and development of any nation can be measured by the size of its banks. The more developed the nation, the bigger are its banks and financial institutions, and vice versa. The prosperity of a nation generates wealth and liquidity, which in turn builds the balance sheet of its banks, where that wealth and liquidity tends to be finally deposited. Therefore, if you see the list of the world's biggest banks by their total assets, you will find that this list is dominated by those from the world's biggest economies, which is USA, China, Europe, and Japan. The top four global banks in 2021 were from China, with the number one being the Industrial and Commercial Bank of China, having total assets of about $4.2 trillion, making it almost 7 times the size of State Bank of India, our biggest bank. The fifth bank on the list of the biggest global banks is the Mitsubishi Bank of Japan, with assets of $2.8 trillion, followed by JP Morgan Chase Bank of USA at number 6. In these terms, our homegrown State Bank of India ranks at a lowly number 43 in the world. The size of these banks verily reflect the size of the economy where they have emerged from, where they grew and became giants. Most of these banking giants did not grow big organically only. Over the decades, they have all acquired, merged and amalgamated other banks and financial institutions, and they have thus made their balance sheets and their market size much bigger, so as to be able to dominate the funds, the bond and the credit markets of their economies and also of the world in turn. For example, HSBC has acquired dozens of banks worldwide in its history so far and is among the top 10 banks globally today. Bank mergers create bigger banks which enable bigger lending, particularly for infrastructure and corporate loans, and their size also enables them to take and absorb the risks of lending and investments in a big way. The size of the balance sheet matters the most in the banking business, and apart from reasons of market domination and growing access to cheap funds, because of a big balance sheet, the possibility of earning higher profits improves. Even the banking regulators worldwide today prefer big banks so that they can cross the threshold of being what they call too big to fail, giving a feeling of safety of public deposits, even though we think that that is not quite true all the time. If that was so, then big banks would just not have failed, but they yet do. The RBI has always had the fear of bank failures, the fear of failure of NBFCs. With the failures of NBFCs in India, including the likes of ILFS, DHFL, Shrey, etc., the RBI has been tightening its regulatory controls on the banking and financial industry of the country, such that its supervision and regulation of NBFCs today in terms of liquidity, capital adequacy and NPA regulation is at par with that of banks, particularly when it comes to the regulation of large NBFCs. Earlier, banks were considered to be heavily regulated by the Reserve Bank, and NBFCs faced a much lighter regulation. But that has changed. That difference is now gone, with a worried Reserve Bank of India keen to prevent any further NBFC failures in the country. The regulatory arbitrage between the NBFCs and the banks, which incentivize players to be NBFCs and not banks so as to not be governed in a heavy manner, is thus no longer there. For those NBFCs that have an asset base of over rupees 1 lakh crore, the Reserve Bank firmly nudges them to get converted into banks and meet the stringent requirements of CRR, SLR, LCR, and priority lending norms. It is in this background that we must see the proposed merger of HDFC, India's largest housing finance company, with HDFC Bank, which happens to be India's largest private sector lender. The other reasons for this merger are that HDFC Bank's net interest margin, which is its gross profitability, has been slipping of late, and it needs to shore it up through a more profitable mortgage lending, which happens to be that in HDFC. And HDFC too in turn needs access to low-cost funds in order to remain competitive in the housing finance market, where it has been an unquestioned leader so far, but its leadership status is now being eroded by public sector banks who have the benefit of being able to lend at much lower rates of interest as compared to HDFC. While HDFC started operations in 1978, it promoted HDFC Bank after getting a banking license in 1993. The bank was inaugurated in 1995 by Dr. Manmohan Singh, India's then finance minister. That thus makes HDFC the parent of HDFC Bank. No wonder Deepak Parekh calls the merger of HDFC into HDFC Bank as akin to a grown-up son acquiring his father's business. He calls it a merger of equals, which is friendly and not hostile. It is finally a family matter which is going through. The post-merger balance sheet of the combined entity because of this merger will be almost 18 lakh crore rupees, with a net worth of about 3.3 lakh crore rupees and annual profits of 50,000 crore rupees. And because of that, it will have strong capital adequacy and asset quality ratios. Upon merger, the shareholders of HDFC will receive 42 shares of HDFC Bank having a face value of rupee 1 against their 25 shares of HDFC, each having a face value of 2 rupees. It will be the second largest bank in India after State Bank of India, and it will be twice the size of ICICI Bank, which happens to be India's third largest bank at the moment. Subject to approvals primarily from the Reserve Bank of India, the deal is expected to be closed in 18 months from now, sometime around Q2 or Q3 of financial year 2024. While Deepak Parekh will not be on its board of directors, having crossed the age of 70, the bank will, however, be headed by its current CEO, Mr. Shashi Jagdishan. Depending upon Reserve Bank's approvals, the subsidiaries of the HDFC will become those of the merged entity upon such merger. As we said, HDFC began its operations in 1978, and it has one of the finest leadership and talent base in this sector in India, which explains its successful track record of setting up a bank and numerous other subsidiaries in the business of life insurance, general insurance, and asset management company, civil, etc. The question that arises is, why is this merger taking place and why now? While announcing the merger of the two HDFCs, its chairman Deepak Parekh said that after 45 years in housing finance business and providing 9 million homes to Indians, HDFC too had to find a home for itself, which it has found, according to him, within its own family and in its own bank. He explained the reasons for the merger and said that over the years, various regulations of banks and NBFCs have been harmonized, thereby enabling the merger. It has become far more easier and far more compelling to merge an NBFC with a bank. He then said that the resulting larger balance sheet of the two will allow the underwriting of large infrastructure loans by HDFC Bank. He further said that it will accelerate credit growth in the economy and it will also boost affordable housing in India. He finally said that this merger will increase credit to the priority sector of the country, including loans to the agricultural sector. HDFC Bank CEO Shashi Jagdishan said that due to the merger, the bank will have a complete range of product offering. It will have product leadership in housing loans and other retail asset products. He also said that it will have distribution strength, a customer base that can be leveraged to cross-sell a complete range of financial products, and it will result in significant market gains according to his estimates and predictions. The stock markets cheered it, and so did experts who called the merger the biggest and the largest and the most transformational merger in the financial services sector. They pointed out that the merged entity will get an unparalleled advantage through the mortgage portfolio, and it will get a quantum leap in distribution to semi-urban and rural areas with a huge opportunity to cross-sell its products. Experts point out that with 30% of HDFC borrowers being account holders of HDFC Bank, there is a ready and clear market for cross-selling of the HDFC products to all these borrowers and account holders. The larger picture that emerges in terms of positives, negatives, and challenges to the merger are certainly worth a discussion. The first point, the merger complements the operations of the two entities, with HDFC Bank needing the benefit of the profitable mortgage business of HDFC in order to shore up its net interest margin, which has been falling off late. And HDFC also needs access to the low-cost funds of HDFC Bank in order to ward off competition from the public sector banks who are aggressively encroaching upon its domain of housing finance by lending at much lower rates. The second point, this is a friendly merger in the same family, and thus there is a minimal risk of failure of the merger, either because of cultural issues or integration of the two entities, which happen to be the most common reasons why mergers tend to fail. Cultural issues and integration, and both are not a problem here. Moreover, with parity of Reserve Bank regulation between NBFCs and banks, the operation of the two entities will merge easily and very seamlessly. The merger time is expected to be much lesser for such a comparative merger. The third point, the merger is resulting in the extinguishing of HDFC's own shareholding in HDFC Bank to the tune of 21%. And that means that this merger will be EPS accretive from day one because the equity has shrunk to that extent. Further, the new entity will be fully owned by the public, making it a truly professionalized bank in the offing. The next point, the merger will boost the revenue. It will diversify the revenue, and it will also increase the market share of the combined entity. With a large balance sheet, HDFC Bank will be able to raise much larger amounts of low-cost funds, thus giving it far better lending opportunities in the growing market. The consolidation will give it better economies of scale and greater opportunities in order to cross-sell the products, which all of them see as a major plus in this merger that is taking place. It will improve the business volumes of HDFC Bank, which has been struggling with sluggish corporate lending of late, and it has also had a poor pace of customer addition in the last few years. Finally, with huge sums needed in order to meet the bank's expanded SLR and CRR requirements of about 80,000 crore rupees, and also the need for priority sector lending going up by about 90,000 crore rupees in order to meet the Reserve Bank's requirements. And all these, priority sector lending as well as CRR, SLR, are considered to be low yield items. Because of that, there will be a setback to the bank's profits in the near term, unless the Reserve Bank gives it a very phased plan over a few years in order to meet these requirements of CRR, SLR, and priority sector lending. The fact is that the merger is driven by sheer commercial terms, which is good for the entity and also its shareholders. But then it all depends on how soon the Reserve Bank approves it and on what terms that is do that. A merger of two successful entities from the same family to us should be immensely successful, unlike the merger of failed banks as also that takes place from the same family in the case of government-owned PSBs. And those banks, that is the public sector banks owned by the government, their mergers have certainly been failures. As far as the merger of HDFC and HDFC Bank is concerned, we think it's going to be a winner. It'll be good for the bank. It'll be good for the investors. It'll be good for the industry. It'll certainly be good for the shareholders of the bank. This is Akhilesh Bhargava signing off till we meet again. Namaskar.